Hey traders, Jason here from Levitt Brothers. After taking a bulk of the summer off from posting videos, I'm going to get back into the swing of things. Back in town, kids are going back to school. We can get back into a routine here. All right, so overall, market's doing still fairly well. In the near term, it has been weak. The indexes have been pulling back off their highs. The pullback has been pretty tame, no big deal. But beneath the surface, there have been some big losers. This is not entirely a surprise because Breath gave us pretty good warnings over the last couple weeks that some weakness was probably going to play out. So I'm going to go through some of the Breath indicators that I look at. If you got these, fantastic. If you did not get these, that's fine. Make a note of it. Monitor these indicators. And the next time the market goes on a run, either up or down, you can use these to give warning of reversals, and you won't be surprised the next time around. Okay, that's just the way things go. We all miss things, especially when we're starting out. You get hit upside the head, and then you realize that, like, hey, if I was following X, Y, and Z, I would not have missed this. Okay, these are just simple breath readings. They've been around forever. I'm not inventing anything here, so I'm not going to take credit, but if you follow them calmly, peacefully, let them do the talking, and you just follow them without arguing with them, they can guide you pretty well. All right, let's get to it here. All right, so first up this is just the advanced decline ratio. Okay, blue line up top is the S&P 500. The gray line down below is the advanced decline ratio. So very simple. When the market was had gone on this run here, the advancers were beating decliners by that much. Fast forward several weeks, the market went up, paused, legged up again, and when it was over here, advancers were beating decliners still, but by a smaller amount. Okay, so there was some stocks that were not participating. A few weeks later, market is even higher, advancers beating decliners by a lower amount. So as the market was moving higher, the AD line was still above zero. There were more advancers than decliners, but the ratio is getting less and less. Less stocks participating, less stocks moving up each day. So not a surprise that, like, you don't know when a decline is going to come, but you know that, like, at some point in time, with participation declining, at some point in time, you know that there's going to be a pullback, and we got a pullback, as you can see in the S&P 500. Okay, so these divergences appear all the time, and you want to watch them. Lower high, higher high, higher high. Internal pressure builds, and the market's going to come down. All right, next chart is the similar, but instead of advancers and decliners, we're doing advancing and declining volume. Okay, advancers and decliners let all stocks talk equally. Apples are worth exactly the same as some little small micro cap, but when you're dealing with volume, obviously the bigger stocks that trade more volume are going to have more say. So the analysis that we use is pretty much is the same. Okay, so we have market moves up to a higher high, less volume going into advancing stocks versus declining volume going into declining stocks. That builds internal pressure. At first, the market can absorb that. The market can continue to press higher for a period of time, but eventually, if that divergence forms, internal pressure is too big to overcome, and the market is going to come down, which is exactly what happened here. Okay, over the course of a couple weeks, the market grinded higher, pushed higher, less volume going into advancing issues. The market eventually came down. So we were warned that internal pressure was building. Next up, so this is going to be the 5-day high-low. Okay, so stocks making a 5-day high versus stocks making a 5-day low. Short-term indicator gives you an idea of what kind of participation is this. If you have a lot of stocks printing 5-day highs, this indicator is going to be up and healthy. As the market continues on, you expect the number of 5-day highs versus 5-day lows to remain healthy, but if it declines, it tells you less stocks are printing 5-day highs. Okay, and this is what happened second half of July, beginning of August, where market moved up and moved up more, but there were less stocks trading at a 5-day high versus a 5-day low. And you can see that just builds internal pressure, and eventually that internal pressure is too big, too much to overcome, and eventually the market pulls back. Doesn't mean the market has to crash or fall a lot. It just means in the near term, when the 5-day high low starts to diverge from the market, you got to look to take profits, look to tighten up stops. Don't be so aggressive. You know that there's going to be a little bit of weakness in the near term. Okay, backing up a little bit, here is the 1 month high low. The analysis is exactly the same. Okay, a little bit longer time frame, but we're still looking at the same thing here. We got market moving up, higher highs, higher lows, and less stocks printing 20-day highs versus 20-day lows. At first, it's not a big deal. The market could definitely continue to push on for a week or two while this divergence starts to play out. But eventually, weeks 2 to 4, the internal pressure is just too great to overcome, and the market is going to come down, which is exactly what has happened. Next up, this is a 3-month high-low. I look at all these. You probably don't have to look at all of them, although why not? It doesn't take that much extra time. This is stuff, all this stuff is available at barchart.com for free, so it's not like I'm doing anything special here. Similar divergence occurred. Market pressed higher. The very last push to a higher high for the S&P 500 saw less stocks at a 3-month high versus a 3-month low. Internal pressure building, less participation, less stocks coming along for a ride, less stocks printing a 3-month high versus a 3-month low, and eventually the market pulls back, as you can see. All right, last one here with the high lows is the 52 high versus 52 week lows. A lot of longer term traders will think this is one of their most important indicators. If stocks are printing 52 highs, that's a great sign. If it's less stocks start printing a 52 week high, that's a warning. This is what we got towards the end of this run. And this run is really good here, but in the last stage of this run, we got the S&P printing a higher high over here and then another higher high over here. But as that was taking place, we got less stocks printing a 52-week high versus a 52-week low. And that kind of internal pressure eventually brings the market down. Again, it doesn't have to be a big drop. Doesn't have to last a long time. Okay, that's the topic for another video. But just at least in the near term, you were warned that internally some negative pressure is building and we need to pay attention to it, okay? The way you trade, if I get rid of these annotations, the way you trade, over here when indicators are doing really well is, we're aggressive, we're pushing it, we're trying to make as much as we can, but when we get this kind of a warning, we got to tone things down. Okay, you got to be aware of what the market conditions are. Sometimes you want to push hard because you can have a lot of runners, and sometimes you want to tone things down because you're likely to get breakouts that go for a day or two and then pull back. Okay, you got to listen to these indicators so you can slightly alter your holding times and expectations. All right, last group of charts, we have Russell 3000 stocks above a 5-day moving average. Okay, so Russell 3000, how many stocks in the Russell are above their 5-day moving average? A very simple indicator. As the market goes up, you'd expect a lot of stocks to be above their 5. If the market continues up and a lot of stocks are above their 5, that's great. But if less stocks are above their 5, that means like one by one stocks are pulling back and they're not participating. That could persist for a little bit, but it's not going to persist for longer than a few weeks. So we had the S&P pushing to a new higher high here. Number of stocks above their 5-day moving average was in a downward sloping channel. Eventually, that negative pressure pulls the market down as it did. Next up, similar situation, Russell 3000 stocks above their 20-day moving average. Market pressing higher, number of stocks moving down, and the market eventually corrects. Okay, you're not going to get a super high print. 80% seems to be about like the top, even when the market's extremely strong and healthy. There's always going to be some laggards that aren't doing well. So we got a nice 80% print right here when the market was here. Market moved down, chopped around a little bit, and then pushed up to a higher high. So of course the S&P is above its 20-day moving average, no problem. But here we went from 80% here to 70. So there was like 10% of the Russell 3000, which is, I don't know how many stocks in the Russell 3000. It changes during the year, so I'm not going to say it's 3,000, but 10% less of 3,000. That means like 300 less stocks were trading above this key moving average. It's 300 stocks not coming along for the ride, and if that persists, eventually the market's going to get pulled down. Okay, last chart here, S&P 500, not S&P 500, the S&P 500 up top, yes, but the bottom curve is the Russell 3000 stocks above their 50-day moving average. Same thing. Okay, this one, because it's a longer-term moving average and it would take a bigger move down for stocks to lose their moving average, it actually held up better, longer. But as you can see here, eventually it broke down through a trend line. Okay, if the market's strong, it's going to just trade in a range, kind of like that. The fact that it broke down and trended down so hard kind of confirms the weakness over here and kind of tells you that we're probably going to have a little bit, further downside before we get any type of bounce. All right, so that's what I got for you. If you follow Breath, then you know about this stuff because, again, I didn't invent any of this stuff. It's available for free online. If you didn't get this, if you weren't warned of the weakness that we're currently having, then that's fine. Take notes here, identify sources where you can get this information, and next time, don't make the same mistake. Okay, it's fine to learn along the way, but don't make the same mistake twice. I hope you got something out of this. I will see you next time.